Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together, we want to make the best investments that we can, so thank you so much for joining us. And on today's show, we have Doug Eberhardt. We're going to talk about gold and silver. Any of you who are familiar with Doug's work will know you've got a treat on your hands today. We're going to talk about a lot of things regarding gold and silver and Doug's views on the metals. And some highlights. We're going to talk about why the financial media doesn't want you to buy gold and silver, the two failed attempts by the U.S. in the past to print money, and what it means to be an intelligent gold bug, and why hyperinflation, wait for it, is not around the corner. Wait for it, why the dollar is not collapsing, and why Doug is currently dollar bullish, believe it or not. And also we were talking about his expectations for a coming deflationary contraction and what he expects to happen with the metals following that contraction. A lot of great stuff. He's going to tell us about buying gold and silver, which one maybe would be better to start with, and all kinds of fun stuff like that. So going to have a great time with Doug today. And as I mentioned before, if you would like detailed notes highlighting or capturing the highlights from today's show in case you missed something or you're going to remember it for later on, you can simply text the word family notes. It's two words, but as one word, family notes, to the number 44222, or visit investorinthefamily.com and sign up, and we'll be sure to get you taken care of. If you want the detailed summary sheet of all the highlights from the show, be sure and do that, and we'll take care of you there. Remember, our goal is to help you learn to invest financially and in all of life. You can always find more at investorinthefamily.com. And you can subscribe to the podcast at iTunes and the Google Play Store. And I hope you enjoyed today's interview with Doug Eberhardt. Well, hey, Doug, welcome to the show.
Thanks for having me on, Brian.
Well, Doug, for people in our audience who may not already be familiar with your work, do you mind sharing just a little bit of background as far as what you do?
Sure. I have been in the investment business for a little over 30 years now. And I started in the insurance business, learned the investment side when they expanded into that, and then went off on my own. And I was actually studying for the CFP exam and read the book on investments and just decided at that time I knew enough about gold and where gold fit in a portfolio that I didn't like what I was reading and decided just to kind of go after that industry. And so I wrote a book, Buy Gold and Silver Safely, to kind of help people understand that for which they don't know about gold, because most people don't know anything.
Sure.
And as far as gold and an investment in a diversified portfolio, I think there's a good reason for it. And from there, I decided that, this book hit the 1% who actually goes out and buys a gold book, and I needed something to hit the other 99% of investors. And so I actually wrote a book just a few weeks ago that came out called Illusions of Wealth. And that book goes into the basics of investing, a way that it really, in our system, our education system, has not been addressed. And in doing this, it kind of opens people's eyes to what they don't know about just regular investing. And because most mutual fund managers don't beat the indexes, hedge fund managers don't beat the indexes, for some, just a simple index fund is good. And I just kind of open people's eyes to that. But then I go beyond and get people to think outside the box first.
That's great. You said you decided to pursue the gold and silver industry. Approximately, what was the time frame of that?
That was in 2002 when I first started discovering it as an advisor through the work of Richard Russell. And he had the Dow Theory letters, and I met people from all over the world, and it gave me a different perspective on investing that I hadn't heard before. Things like Austrian economics and living within your means as a government. And what I did from there, it took me about 4 years to really get to understand the industry. And then it took me another 4 years to write the book, Buy Gold and Silver Safely. And during that time, I pretty much consider myself one of the few experts that understands gold inside and out, and also has a business that is different than most other gold dealers out there that you see advertised on TV, because I don't sell the numismatic or rare collectible type coins, and I just stick with mostly the bullion coins.
Right. Well, I would love to hear, there's so many questions I have. I know that you have, okay, let's go back. What made you said in 2002, you started to pursue the gold and silver industry specifically, via the work of Richard Russell and stuff. Was there, I mean, obviously that was a great time to get into buying gold and silver. What was it about it? I mean, that was a time when people weren't really liking the metals, but what made you like them?
Well, my dad was a commodities broker for the
Gotcha.
Chicago Board of Trade. So way back in the 70s, I would be reading the newsletters that he would give me from some of the old timers. And what happened then is I never thought I would get into commodities. I knew I wanted sales of some sort. But, after college, I kind of went into that direction just through the insurance industry, as I said. And what happened was I ended up falling in love with gold. It took a little while, but it took that change in understanding of what the industry was trying to push us to sell as advisors that really got me to change, and how they badmouthed gold for all those years, and how I probably badmouthed it at one point too. And they put it at the top of the pyramid as the most risky investment. And in reality, you take a 1964 silver dime, and it's has a value of 25 cents, could buy you a gallon of gas back then. And today, that same exact quarter, if exchanged for the scrip of the day or dollars, could still buy you a gallon of gas. And that's because it has 90% silver. Whereas a 1965 quarter buys you 25 cents worth of gas. And that lesson alone is something I think most people need to understand when it comes to protecting your purchasing power, which over time, both gold and silver do.
Tell me, could you tell me the story of gold in the last 50 to 100 years? And that, I know that sounds like an insanely big question, but I really love to just walk through a little bit about how it's fit into our financial and monetary system over the last 50 to 100 years.
Yeah, you can trace, say, the purchasing power, or the value is a better word, at least historically, of metals, to the times of Jesus, when Judas sold him in for 30 pieces of silver, through the Roman times when they would, or the Roman Empire era, when they would actually pay their armies in the gold that they confiscated from country after country, and the fall of the Roman Empire, to where they stopped conquering countries and they ended up actually devaluing the gold that they were giving the soldiers to where it was really worth. You could feel the weight was lighter and lighter, and so worth less and less. And then there was the fall of the Roman Empire. So when you debase the money, that historically has ended in ruin for the countries that did the devaluing. And you could take that through history into the two failed attempts by the United States to print their own money, and the current one, which in 1913 was the Federal Reserve note creation, which those actual bills used to be redeemed in gold coin. And then in 1933, we ended up having a situation where Roosevelt confiscated gold, and they ended the ability for us to take our $10 gold reserve note to the bank and exchange it for gold. And now it was exchangeable into nothing after 1933. And today it's the same thing. And if you look at the bottom of the bill today versus what it was then, it's just not the same money. And so throughout the history of time, it's governments that actually cause the problems with the devaluation of money over time. And eventually all currencies, they do come to an end, but I am dollar bullish. You might want to ask me about that, why I am a little later. But it is eventually something that all currencies, or it'll take more of them to purchase gold as time goes on. And
was it 1971 when Nixon, I'll say, ended the gold standard? Is that when that was?
Correct. It was 1971. And basically at that time, it was like, take our Federal Reserve notes or or don't. And from 71 through 1980, we saw a lot of inflation, a lot of worrisome people when it comes to their value of their money. We saw interest rates take off, and we saw gold and silver both take off to all-time highs by 1980.
Well, and one of the things I think about, because it seems you mentioned this a little bit while ago when you were in the insurance industry, or I'll say the finance industry to be really general, and some of the products that you were, encouraged to sell, and how gold was usually really talked down upon. And even now, I almost feel sensitive if I ever bring up gold as an idea or silver to invest in. You're just waiting for someone to call you a gold bug. And that is always a negative term when someone uses that, it seems like. But the thing that for me that is problematic is, looking at the history of things, like you just gave a really great quick overview. Since 1971, that's, I guess, it's close to 45 years, almost 50 years. Like, this is a really short period of time that that our currency hasn't been backed by gold. But it's a really short window, but people act like it's this new paradigm that will never go back. Does that make sense?
Oh, sure. And it is a short amount of time. And the media, the financial media, doesn't want you to believe that gold has any value. Anybody who sells stocks or gets paid to sell stocks,
right,
or advertises on these shows like CNBC, they don't want you to buy gold. There's just nothing that gold does for anyone except over time maintain purchasing power, and that can't be denied. And so what people will try to do is compare gold to stocks, and I think that's the wrong dynamic that people are looking at. It's okay to have stocks. It's okay to have dividend-paying stocks. It's okay to have some gold in your portfolio as a hedge. And some people would call it insurance against what our government might do to our money or has done to our money.
Yeah, and because that's something that happened too. People say, you used the illustration before about a 1964 quarter versus a 1965 quarter, the one that was 90% silver, then the other one that was just nickel and clad metal. And people say, yeah, but okay, that's preserved value, or it's gone from 25 cents to, I don't know, like $5 now or whatever it would be worth. I can't remember. But the people say, yeah, but if you invested, money in this stock at that time, it would have increased by 100x and stuff. And so, when you're, as an investor, you're trying to think of, okay, if I think of wealth as, I'm storing purchasing power, like you said, and in reality, and you just put currency on par with any other asset because they all rise and fall in terms of value. You want to be able to store your value in the best asset class at the right time. And so it seems like for a long period of time, it seemed like, well, stocks were definitely a better place to be purely in terms of gaining wealth. And then it seems like, if you had your money in gold for several decades, it didn't seem to make a big difference. But I agree but that seems like, I get that comparison. I think there is some level of validity there, but it's also, there's something missing. Could you speak into that a little bit as far as why there's a bigger picture there? Yeah.
One thing that I do, since I have experience on all sides of this, I do consider myself a gold bug, but at least an intelligent one that knows that there's another side to it, and that the dollar's not going to crash, and I don't cry for it to crash every year like some do, and that hyperinflation's not right around the corner that some may think is coming as well. But there are times when you need to be dollar bullish and gold negative, and the opposite. And right now, we've had a little bit fall in the dollar from 100 down to the 90, was down to 92. Now it's 94, 95 level. And we see gold moving right along with it. And I'm actually dollar bullish, and this is part of the illusion that most people don't get when it comes to gold, is that the dollar itself is made up of 54% the euro, 13% the pound and the yen, and a little bit of a few other currencies. And when you have 70%, 80% of your dollar in countries that are kind of overall struggling financially with debt to GDP ratios worse than the U.S., I think there's a good chance that we still might have that one more smackdown coming in gold. And the question is, with the stock market being so high, can things fall apart again like they did in 2009 with a deflationary contraction? And where it doesn't matter if you're in stocks or gold, we could get hit. And the odds are that it might happen. The question is, does a holder of physical gold care that it falls? Probably not, because most people who buy don't sell. Mm-hmm. But you have to have the conviction that it'll go higher as well. And then it's not as much as a dollar issue that the dollar will fall and gold will rise. I think gold will rise in all currencies once this contraction is over with. And I write about the contraction in my book, and I use what's called Exter's pyramid as my basis for that. And John Exter was one of the people involved in advising Paul Volcker back in 1980 when Volcker came to him and asked him what to do. And Exter said to loosen monetary policy, you have a Fed today that the market trades off of. The market doesn't trade on valuation. We know that. And it is overvalued based on PE ratio analysis. And so when you have a market that trades on the Fed, you've got to look at the dollar as to what it's doing to have a secondary way of valuing gold, or is it a good buy now or not a good buy now? And I know over time it moves with gold or opposite gold. And right now we're in one of those times where even today the dollar moved up and gold went down. And but Friday was an unbelievable day for being short the market and short gold both. So you're going to have a situation where you don't have to choose one over the other. But at times you have to be smart enough to know that they both can move together. And I think the dollar is the key to understanding when to be long one and or short both or long both.
Yeah. Well, and I like the way you said, you are a gold bug, but an intelligent one, which I appreciate, because I definitely am pro the metals, because I believe that they have, there's a lot of good reasons I think to own them. And I agree that you mentioned the two big things, the idea of the dollar collapsing and then hyperinflation being right around the corner, because that's where you kind of get into the negative terminology with gold bug a lot of times. Was like, you have your metals and you also have a bunker in the backyard and all that kind of stuff. And that's another conversation, and that's fine. But when it comes to the metals, like I agree, like I don't think waiting for some calamity makes a lot of sense. And I don't really see that coming. But then on the same hand, you look around the world and you mentioned, Europe, Japan, China, debt issues, the U.S. debt issues, and the quantitative easing. And it's like, yeah, I don't get in like a panic crazy camp, but I'm also in a camp too of, isn't this kind of insane though? Like, and at some point, and I don't like saying things like gold to X number, but it seems like gold doubling in value in coming years doesn't sound like that crazy to me. Does that? I don't know. Like, what do you think about some of that?
Yeah, I can answer it maybe this way, in that we have a national debt right now that's over 19 trillion. And we have a Congress that at some point is going to change here with this next election coming up. And they voted in a budget, what they call a balanced budget, which is 9 more years of spending and the 10th year coming in under budget. So this 19 trillion number is going to go to 24 trillion, whatever that number is, over the next 8 years now. And it doesn't really matter who's elected, but this is what Congress does. They just add more debt, and there's no worry by any of them as to what will come from that. Well, when interest rates start to rise, when money velocity starts to tick up, then the worry will start coming. And then you'll see either you have to make cuts or you have to print more money. The problem is the Fed's going to be behind the 8 ball again, as they always are, and act too late. And so that's one of the problems that I see coming down the road. And when it comes to gold doubling from where it's at, I have no problem with it doubling. I think silver will probably double before gold, and I advise people to buy silver, have it double, sell half the silver, and buy free gold with their proceeds.
Sure.
And gold is a more conservative way to go. Silver, it could even triple before gold doubles at this point. But I'm not one that really goes out on a limb and says, gold's going to X amount of dollars. I do look at it from a micro and a macro level. The micro is more iffy. The macro, I don't even worry about where gold's going just because of history that we've discussed and what government does to money.
Yeah. Well, and I think that's kind of a little bit where I'm going as well, because what I own, I see it as, I'm fine passing this on to my kids and their grandkids. Like it seems to me, and like you said, most people who buy physical metals, they're not trading, they're not looking to offload it in 2 years or something. And whether it be a generational store of value, I think of it as, and maybe this sounds weird or whatever, but I think of it as, man, when I buy the metals, I'm buying, generational value. Like I'm buying something that I think I can pass on in my family and know that it will be a backstop for them, or however you want to think of that. And I think of it as a hedge against central banks. Like I totally avoid any kind of price targets, like you mentioned. That's why I said doubling in coming years, because that's compared to what a lot of things we can read. That's an extremely conservative statement. Yeah. But for me, that's helpful because I feel like, well, if I had any investment double in a couple of years, I'd be pretty happy with that. And so that helps me think then, if I buy gold today at 1320 something, or if it drops to 1,000, that's very disappointing. Obviously, I would love to have bought it at 1,000, but timing those things is very difficult. And maybe I know that from reading your site, you talk a lot about averaging in, which I highly respect and think that's obviously it's hard to ever argue against the wisdom of that.
Well, let me address that real quick. I look at the market, the gold market today, as I did the Dow in 2009, where some people bought at 8,500, others waited till the bottom at 7,500 on the Dow. But sitting at 18,000 plus today, I don't think either investor really cares where they bought,
right,
or remembers. And that's where I think we are with metals today. So I use that analogy a lot along with the dollar cost averaging in, just to kind of take the guesswork out. And as long as you have faith that at some point gold and silver will take off, which I do.
And so when you say take off, tell me a little bit about what you mean by that. What do you think?
Well, takeoff to me would be, I still want to see this deflationary contraction happen. So
right.
The question most people will ask, when I write articles that say in the past that gold will fall below 1,000, why I thought market makers would take it below that psychological level. And they still might, it would break the backs of every gold bug if they did it right now. So the question is, are we still going to go through a deflationary contraction? Well, I think China has a huge contraction coming. I think Japan is going to inflate as much as they can because they have no choice. I think Europe is a total disaster in so many ways. And that's, again, 80% of the dollar. So I see the dollar moving back up to 100 and higher, and that could put pressure on the metals. Once that's over with, then I see gold and silver. I don't use the words to the moon, but what's going to stop it? If you look at Exter's inverse pyramid, it's got gold at the bottom, but sitting outside of the pyramid because it's no one else's liability. And as these assets kind of contract, looking for a home, it's U.S. Treasuries first. So I'm actually Treasury bullish. And then, and I have been for a while. And then gold sitting outside as no one else's, again, liability. And we'll see what happens. I mean, over time, it maintains your purchasing power and you have a little insurance. So why not have some gold and silver?
Yeah. Well, and I think of it too as it's real, and again, not to get, you can easily take these things to extremes and I'm not intending to do that, but I can own company in a stock and it's digits on my Fidelity or Trade King account. And I can, I've got digits in my bank account and all that kind of stuff. And I'm not in any way saying that I can't get that money out or it's not real and stuff. But there, even some people that have been in the industry for a long time that I highly respect, that I consider very conservative, and they won't get in, and they're very optimistic as well. Even they'll say kind of what I'm saying is like, yeah, but at the end of the day, the real estate my home's on is real. I can hold gold and silver in my hand and it's real. And I guess that's the same idea if you're talking about it being outside of Exner's pyramid. The inverse pyramid is I don't know. I want to elaborate better on that, and you probably can, but I just keep wanting to say that it's real, and that is meaningful to me.
Well, it's real and it's liquid.
Yeah, exactly.
I think
yeah.
liquidity is key there.
Right. Do you see, coming back to the idea of asset classes, bull market in one, bear in the other, and kind of exchanging and how that they can cycle through each other. When you think of buying gold and silver and you talk about after the deflationary contraction that you're expecting, and then after that, gold and silver, quote unquote, to the moon, do you see that? And I mean, and I'm not trying to be extreme there, but just that idea. Do you think, then at that point, I want to exchange it for something else? Or you think, man, I'm just going to hang on. And if I need something, I'll buy a house with it or something. But do you have thoughts of rolling it over into something new? Or?
Well, here's the interesting thing is technically the dollar cannot crash. If it crashed, then by default, all of these other currencies, the euro, the yen, pound, et cetera, would have to skyrocket, right?
Right.
And so that's, again, part of the illusion. So, yes, at some point when it's doubled, tripled, whatever it is, I'll come out with an article that says it's time to sell gold and start getting out of gold. And can it still go double from there? Sure, it could. But I'm going to start to say, look, here's what's beaten down, whether it's real estate, whether it's stocks, I don't know. And there might be a better opportunity in other assets. And that's what I write about in the Illusions of Wealth book is simple asset allocation. Models can dictate at times what to take from and what to put into.
Sure. Okay. And you've mentioned something that a couple of times that I want to make sure I'm understanding it. You talk about how you said the dollar is made up of the yen, the euro. Help me understand, help our audience understand what you mean by that to make sure there's no confusion.
Sure. Absolutely. If you look at what a dollar represents, it represents other currencies only. And so it has what's called an index, and that index goes higher or lower depending on what these other currencies can get you in the dollar. So, for example, the euro itself makes up 54% of the dollar. So if the euro goes down, then guess what? By default, half or 50% wise, the dollar will go up. So the euro is a huge part of the dollar, and it's something that you have to be careful of. The euro is actually 57.6%, the yen 13.6%, the pound 11.9%, the Canadian dollar 9.1%, the Sweden krona 4.2%, and the Swiss franc 3.6%. So that's the numbers, but the important ones that I look at are primarily the euro and the yen. That's what I've been talking about for 5 years. And I've been bullish for 5 years on the dollar from 72 on up, and negative on the euro and the yen, and I'm still negative on them. And I'll throw in the pound now too. It's just a matter of that illusion that if one goes down, the other must go up, and vice versa. So if the dollar is going to crash like a lot of these gold bugs say it's going to, then tell me how these other currencies with their worse debt to GDP than the U.S. is going to go higher. And I just don't see it. And
so the dollar is made up of those other currencies in the sense that they're all so related to each other in terms of international money movement and everything else. Is that kind of part of the idea?
Yeah. So every currency is going to live and breathe based on its own own central bank maneuvers. And right now you're seeing in Europe and elsewhere negative interest rates. What are they trying to do? They're trying to stimulate their economy. Japan's been trying to do it, fighting deflation for the longest time compared to all these currencies. But are they winning that battle, and can they win that battle? Well, you've got to have production. You got to have growth. We're not seeing that. We're not seeing it here in the U.S. either, mind you, but it's the lesser of two evils. Most of the world views the U.S. as a stronger currency. They don't view that as the euro right now, with not just their negative interest rates, but their refugee crisis. They still have a banking system that's messed up. The powerhouse Germany is starting to crack a little bit. Japan's already been through this, as I said, and what's gonna get Japan to go now when their own exports, which is what's carried them all these years, are now starting to decline. So every country that makes up this index for the U.S. dollar has, I think, worse issues than the U.S. Everything's perceived great here. I don't know if you go out and talk to people, but people are buying stuff and everything seems fine here in the U.S. The underlying data doesn't really support that, but you can't ignore price action. So you've got to trade that from an investment point of view too. Right.
Yeah, no, that makes sense. And it was that whole idea that the U.S. is the best looking house on a really bad block type idea, I guess.
Yeah.
Well, Doug, this has been fantastic. And again, yet another interview where I think I could talk to you for about 3 or 4 hours. So maybe we'll do it again sometime, but this has been great. Your background and your perspective on the metals is deeply appreciated. And we thank you for your time today.
Thanks, Brian. I appreciate it. And people can go to illusionsofwealth.com for more information.
Absolutely. Thank you.
All right. Take care. Bye.
Well, I hope you enjoyed today's interview with Doug Eberhardt. Remember, you can get full show notes with links and other details at investinthefamily.com. Don't forget to subscribe at iTunes, Stitcher, or the Google Play Store, whichever is your preference. And if you want to receive my summary sheet of highlights from this show, simply text the word Family Notes, one word, Family Notes, to the number 44222, or visit investinthefamily.com and sign up, and we'll be sure and get you taken care of. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.